Would you believe me if I told you that we turned a struggling mobile home park into a property that doubled in value within a year? Sounds pretty crazy, right? Well, stick around because I'm going to show you exactly how we did it and how investing in mobile home parks like this can create some truly life-changing financial returns. Let's go back to when this started. Back February 2023, my business partner and I, we purchased a mobile home park down in South Louisiana for $4.2 million. Just a year later, we had it appraised. It was now worth $8.4 million. Now, here's the journey that got us there. And then I'm going to talk to you about the lessons that we learned along the way so that you can also enjoy this and learn it too. Now, this wasn't just some sort of lucky break. It was actually a calculated decision backed by the solid research both my business partner and I had. All right, now this park, it actually sits between three major MSAs or major metro areas in Louisiana. My partner, before I met him, he already had, I think, 2 or 3 mobile home parks that he owned himself. Now, he also owned parks nearby this park down in South Louisiana. So when his broker presented this deal to him, we basically jumped on it. So let's talk about the numbers. The numbers look good. So there was actually 149 permitted lots, and there was actually 120 tenants that were actually paying rent every single month. Now, on the surface, this seemed like a great investment. But when we started looking at the numbers, when we started diving a little bit deeper, we realized the park had truly been bleeding money for actually 3 consecutive years. The management was poor, the tenants were unreliable, and many homes were actually left vacant or they were just abandoned altogether. It was, after we really started looking at this, it was essentially a Class F property. All right, A being like Taj Mahal, B being, really good but not super great, C being a little bit mediocre, down to F. So you can imagine what an F is, okay? It was essentially a Class F property, like a business that shouldn't have been printing money, but instead it was actually circling the drain. So what did we do? We got creative. My business partner and I, we actually, when we bought the park, we actually split the down payment 50-50, but we didn't stop there. We noticed that 25 homes were in just absolutely terrible shape. And they were really completely unlivable. I mean, they were bad. So we made the offer, we made the seller an offer. Okay, this was actually before we closed. We said, look, either he fixed up those homes with our crew before closing, or we would just completely walk away from the deal. Guess what he did? He agreed to it. He did it, we closed on it, and then once we officially took over, we hit the ground running. In the first month alone, we sold 20 homes to new qualified tenants. This was in month number 1. We sold 20 homes to new qualified tenants. By month 3, every single vacant home had been sold. And guess what? After we sold off all the homes, they actually brought us in roughly about $300,000. And this was upfront option payments. And we actually used that cash to further improve the park. And then we started to attract more reliable, more stable tenants. Now, the park's rent, we always take a look before we even make an offer on a park. The park's rent overall were slightly below market in that area. Now, the previous owner, he had raised them from $200 up to $385 during the COVID era. But the market rate in the area was anywhere from $400 to $450 per month. And now this is lot rent, because these are tenant-owned homes. And so what we did, we actually implemented a plan where we actually raised the lot rents. Remember, he went from $200 to $385. And what we did, we raised the lot rents from not a big increase, from $385 to $410 a month. And what this did, this actually added $10,000 a month to our rent roll. Now, before we even closed, we actually, and we do this quite a bit, we tested the market by selling 5 rent to own. We call these RTOs, rent to own. So what we did, we sold 5 of these, and every one of them sold within a week. Then we actually built a waiting list of buyers. So we're doing all this on Facebook. So we actually built a waiting list of buyers who actually had passed background checks. They had $5,000 down for option payments, to have a down payment. And they were actually willing to pay $900 a month. So whenever you do a rent to own, if you get a park that's either going to have a park owned home where the park owns it and the tenant just rents from the park owner, or the tenant owned home. We want to convert everybody to tenant owned home. Why is that? Because we don't want any of this to deal with maintenance. We don't want to have any maintenance. So we want to convert all the park owned homes to tenant owned homes. Well, how do we do that? We do that by turning them into rent to own. So they pay a deposit, and then once they pay on a deposit, like a down payment, then they start paying rent. And their rent includes their payment that goes to the rent to own. So they're renting it, and we set up a contract, goes towards buying off the home, plus they're paying us the lot rent. Now, this is literally our strategy every time we buy a park. We want to convert the park-owned homes to tenant-owned homes. So again, we had built up this waiting list, and remember, these people were willing to pay $900 a month. And that $900 a month, remember, included a portion of that was going towards paying off the home, and then a portion of that was going to the lot rent. Then came the tough part. So on day one, we signed the papers and we evicted 200 tenants. You got that right, 200 tenants. 200 people, our biggest ever, 200 people were gone in a single day. Now, I understand it was drastic, but in this situation, it was very necessary. We had to eliminate, and you have to realize that this parks, whenever you would say the name to the park's name, we actually had to change the name, but whenever you would say that park's name into the area, they knew how bad it was. The people in the area, the people in the neighborhood just knew it was bad. So by getting rid of all these people, it was very drastic but necessary, because we had to get rid of all the people. We had to get rid of all the issues that were completely draining the park. We had people that would, have the unpaid rents, drugs, gang activity, just general chaos. We even had some death threats against us as well. So within the first week, we installed payment software on a phone. And we do that with all the parks. We took out all the dumpsters. Why did we take out the dumpsters? Because we want to move the trash payment to the tenant. And then whenever you have dumpsters anywhere, what are you inviting? People to come in to dump their crap everywhere, trash, all right? So we started to clean this up. And again, we were wanting to shift the maintenance responsibilities to the tenant, remember? Because we don't want any maintenance. We don't want any headaches. So within the first week, we started to do all this. By day 30, we had sold 20 homes. And by day 90, every vacant unit was actually occupied. So we bought the park February 2023. By January 2024, the rent roll actually hit $74,000 a month. And then by February, which was a full year, was $76,000. And then we had a rent increase that March. The rent roll actually hit $80,000 a month. And this was March 2024. Remember, we had purchased the park in February of 2023. We had gotten our expense ratio under 30%, and the net operating income, which the net operating income is all the gross income, all the income coming in minus the expenses, that's the net operating income. And now the net operating income is $660,000 per year as it stands now. Now, we actually plan to refinance very soon, and that should actually repay all our initial down payment that we paid, because remember, we split the down payment, but we can also continue these strong returns. You take this plus the added bonus of cost segregation study that we had the first year for the tax benefit. So that gave us actually over $1 million. So the cost seg study we did that the first year, actually gave us over $1 million in depreciation. That was year one in 2023. How big is that? Real estate, it's not magic. But the thing is, when you follow the right path, when you have the right system in place, the results can be fantastic. If you're a high income professional, and if you're looking for stable, scalable investments like this, like the ones that I invest in, but you don't want the headaches of daily management, then make sure that you check out this next video about my favorite investment, real estate syndications.